This month marks one of the most significant shifts in the US economy. Jerome Powell is out and Kevin Warsh is in as the new Fed chair. We're going to see a $2 trillion shift in the real estate market that is going to completely change how real estate is structured from here. And if you don't understand the mechanics behind this shift, you're going to get wiped out. Today, I'm going to show you what Kevin Warsh actually means for interest rates. And I'm going to show you how the top 1% are adjusting their capital to protect their wealth. As of May 2026, Kevin Warsh has officially taken over the Federal Reserve. One of his primary objectives is to unwind the Fed's bloated balance sheet, specifically targeting the trillions of dollars in mortgage-backed securities, or MBS. That is what the Fed has bought during previous crises to keep rates low. When the Federal Reserve changes hands, like we see here with Kevin Warsh, there's talk about the balance sheet reduction. A lot of amateur investors start to panic. They think money's disappearing, right? They think the market's gonna crash. They think the risk is dangerous. And they like to get out before there's this collapse. And that's generally just not how markets go. Things move slow, and Kevin Warsh does not want to come in and have the market completely crash in the first 6, 12, or 18 months when he takes over. And we know for sure the Fed is meeting behind closed doors, and the group of the Federal Reserve is coming up with a very clear plan of action. And then they are voting on it publicly, and they are picking words strategically to manipulate the markets. So the idea of panic selling, the idea of having to move quickly, the idea of, massive change coming, I just don't think we see that. I think the Fed is going to look at the data closely, and they're going to make the best decisions they can based off of unemployment and based off of the war. We may see rates jump up for a moment in time, right? As this war goes on, as inflation rips, as gas prices continue to soar, this energy shock, we've seen it in the past. These energy shocks happen, and there is a moment in time where interest rates go up, more challenges in the economy set in, and then we see things contract. Then we see rates come back down. That's what I think is going to happen over the next 6 to 12 months as we see this energy shock fully affect the world and really the US economy. Warsh wants to sell off the $2 trillion hoard of mortgage-backed securities. If he does that, what that does is it basically signals to the market that not only now are they no longer the biggest buyer, they're also selling. And so it's going to create instability if they do this. And that instability is going to come from investors that are going to buy it wanting a higher return, which actually means higher interest rates. If this happens, it'll be really interesting to see what happens in the market right now, because imagine moving rates higher, potentially significantly higher, when we just saw a jobs report come out that showed 133,000 jobs lost. That was the worst report of jobs that came out since 2020. So here we have the worst jobs report where they're talking about potentially selling off $2 trillion of mortgage bonds, causing interest rates to rise. The only exit I see here is a recession and or pain in the economy if this continues to unfold like they're saying. By the way, if you want to see how we structure our deals to withstand elevated interest rates, scan the QR code or click the link in the description below. The biggest denominator to stay protected in a volatile time like this, you've got war, got a new federal chairman, they're talking about, selling off their $2 trillion of mortgage-backed securities, is you have to have fixed debt. You have to be in a position where you control your debt payment. Every time you go back to the great financial crisis, you go back to this huge recession of multifamily, commercial multifamily that we saw from 2020 into 2024, the common denominator, the same exact variable that caused these deals to explode, was over-leveraged variable rate debt. So in a market like we're in, the biggest protector you can possibly do is when you're buying a deal, to make sure the deal's in a cash flow state and you have a long enough period of time, a long enough runway to significantly increase your rent and control your expenses to increase your net operating income. Because as you continue to increase your net operating income, it adds more safety. It increases your debt service coverage ratio. All that is a measurement of how much income you have versus how much your debt costs. And so when these deals explode, when these deals implode, it's purely due to over leverage variable rate debt. Keep your debt low, keep it fixed, and enjoy the inflationary period that we're going to go through. And that's the winning philosophy that we've been using over and over again on many deals for the last couple decades. That's the biggest lesson we learned after going through 2021. We had some deals that had variable rate debt, and we luckily restructured them into fixed debt. So as you look forward to take the risk out or to reduce the risk as much as you can, because you're never going to eliminate the risk with investing. There's risk by keeping your cash in the bank, letting inflation eat it away. There's risk going into crypto, stocks, real estate. But the way to eliminate the risk or reduce the risk as much as possible is to put in low leverage fixed debt for a very long period of time. So if this new Fed policy, of selling off mortgage-backed securities happens and interest rates do increase, just think of what that will do for the inverse side of our renter nation, right? We're already headed towards a renter's nation. It's been increasing significantly. A huge percentage of people have or being forced into renting now. If interest rates rise again, based off of what the Fed is talking about doing, it's only going to further the gap of what it costs to own a home versus what it costs to rent an apartment. And so the interest rate rising will put further pressure on rents. It will force more people into renting. And just like anything else, apartment rents are set up on supply and demand. When supply and demand get out of whack, it puts more pressure on rents, causing rents to go up. The 99% sit on the sidelines waiting for the government or the Fed to magically lower their rate so they can finally start investing. The 1% understand the Fed doesn't care about your mortgage rate. If you're ready to start investing alongside us, scan the QR code on the screen or click the link below to schedule a call. We'll see you on the next one.